Hello, ladies and gentlemen. Thank you very much for dialing on today. My name is James Penny. I am the Chief Investment Officer at TAM Asset Management. And what I wanted to do today was talk to you about 2021, a little bit about 2022, but touch on a phrase that I know a lot of people find very interesting. A lot of people in the firm have asked me what it means. Team transitory versus team permanent. I think for me that sums up a lot of the year that was 2021. I think it governed the direction of almost every asset class. It governed the direction of where markets are going in 2022. It is, of course, team transitory versus team permanent are the two words that central banks use to describe inflation. You had almost all central bankers coming out at the beginning of 2021 saying inflation is transitory. Do not worry about it. We do not need to act to raise rates to cut off inflation because it is transitory. And as you saw inflation and CPI numbers across the world start to peak out 3, 4, 5. You started to see central bankers coming out and going, okay, well, maybe it's more permanent than we gave it credit for. And the reason why this permeated into markets is because that sequential transmission from transitory to permanent shaped a lot of what investors anticipated central banks were going to do in response. And this is all about monetary policy. This is all about removing the punch bowl of the markets, of the party, which is obviously quantitative easing and interest rates. With interest rates being so low and quantitative easing being in full swing, markets were rallying hard. And that was one of the main drivers of markets. So as team transitory stepped back and team permanent stepped forward, i.e. the rhetoric around inflation being more permanent, investors started to panic that inflation was going to start topping out, and investors started to panic that these central banks were going to start raising rates to get ahead of that, and that forced a change in the markets. So let's move on. This is me, a little bit about me. I won't touch on this slide, but if you want to know more or you want to chat, as always, please do come and talk to me afterwards. We're going to open for questions afterwards, but I'm always at the end of a phone. So let's look at who won in 2021, right? I think that's a good place to start because that outlines team transitory versus team permanent. There was still a lot of bargain hunting going on in 2021, and one of the best areas to go bargain hunting, which TAM was invested into, was US financials. US financials had a stellar year in 2021, predominantly off the anticipation that rates were going to rise at some point in the future. Rising interest rates are very good for financials, but also with the amount of volatility that we saw in the market, traders at banks were making a huge amount of money buying shares one day off a client and then selling them the next day. And then when those shares fell or rose, they would buy them back and sell them on to another person. And that trading activity, that huge increase, drove bank profitability. And because banks, ever since 2008, were so lowly valued, people started to reprice those assets. Banks did extremely well in 2021. So there was very much a value play there. And that's what I've talked about here, is moreover that value element of the benchmark that perhaps hadn't worked in 2020, 2019, 2018, 2017, 2016, that very much started to come to life. And you're actually starting to see a lot more of that right now. The value trade in 2021 was predominantly energy, right? You had a very big rally back in oil. And that was something that drove energy prices higher, which drove prices at the pump higher, which fed through to inflation, which fed through to concerns that inflation was going to get toppy and central banks were going to have to raise rates, i.e. team transitory, team permanent, which conversely fed back into the banks trade. and made that rally as investors thought interest rates were going up. 2021 was a very connected year. This is one of the things that we saw on the side of 2021. I don't think it had too much of an impact for TAM's investors, but meme stocks. And when I say meme stocks, I mean the rise of the retail investor, the rise of an investor that was not a professional investor, that was that had access to a phone, that had access to a Robinhood trading account or an AJ Bell trading account, and they were reading Twitter, and as people were coming on saying, now's the time to buy the dip, let's start buying the S&P, or let's start buying GameStop, and everybody, as the institution would classify them as uneducated investors that had no reason to buy these stocks, started buying them. They started to very much hurt hedge funds that had shorts on these stocks. So I think 2021 was very much a year in which strange stocks that wouldn't normally be in the limelight were suddenly thrust into the limelight because of social media. And that's not something we've ever seen before, but I think that is extremely important as we move forwards. I think never again will Wall Street underestimate the power of an organized retail force. And I think 2021 was a seminal year for that. Looking again at these two, obviously the FTSE and the S&P 500, one was a winner, one was a loser. The S&P 500 accelerated on, much to a lot of investors, against a lot of investors' calls, which were to say that the S&P did so well in 2020 that it should take a break in 2021. The earnings of growth stocks in the S&P 500 index cannot continue to rally. Well, they did. They did extremely well. Now, the S&P 500 is predominantly a growth index. It has growth stocks with earnings in the future. Now, that's very much in contra to the top left, where I've said that banks did very well. Banks are a value stock. So 2021 was a strange year where you had value and growth doing extremely well at the same time for different reasons. And that was all because of this fear around inflation, this fear around where are we in the cycle? We don't know. What are central banks doing about it? 1 minute central banks were not going to raise rates, and you started to see the S&P 500 and growth stocks accelerate. And then we had a high inflation print, and everyone started to worry that the central bank were going to raise rates. And then you started to have bank stocks, you started to have energy stocks outperforming. Unless you were diversified across both sections, across value and growth, it was a difficult year to invest. But a good year for passive investors, because if you just went long the market, if you went long the S&P 500, then it would have returned you a very nice number. Contra to the FTSE once again trailed the market. So what we need to do is we need to obviously make sure that we're accounting for that in the future, in the future asset allocation for this year, is to have a look at how we're positioned against expensive markets on the right and very attractive markets on the left. And indeed, as I'm talking to you, 20 days into January, there's been a massive resurgence in value investing and a huge resurgence of the FTSE. The FTSE last time I checked was up some 2% against an S&P 500 down 3%. That is a very large move for so early in the year. So let's look at who lost. Fixed income took a hit. Fixed income marginally started underperforming in 2021 as the notion that central banks were going to raise rates started to take hold. So people started to pull their positions back. But again, not without its volatility. Extremely volatile market where you will probably know the Bank of England was set to raise rates in September and didn't. That caused a huge UK gilt rally, and everyone was underinvested to that. So that was a very difficult period to be an investor. And, it was a difficult period for TAM to be investing into that market. On the right, we have China and Brazil. For me, that's emerging markets. Asia, Asian equities, emerging market equities, Brazilian equities, LATAM equities, they were all under pressure. Now that was predominantly from a rallying dollar in the second half of the year, but also you had a lot of COVID waves coming out of emerging markets. The emerging market economies were not quite as vaccinated as the developed market economies. And that was a fear. There was a fear that more COVID variants were going to come out of emerging markets. And as such, people started to pull assets away from emerging markets. Again, currencies were a big winner and loser in the year. The first half of the year was very much a pound story. The pound started rallying, the dollar started selling off. As the market got more and more aggressive in the first half of the year, the returns were very good, and that was predominantly in line with a weaker dollar. But then as you started to see concerns creeping in around Omicron in the middle of the year, towards September, the dollar started to rally as people started to fear that growth was going to take a hit and central banks were going to have to raise rates. That was very much a dollar positive environment. So we had funds that were invested into both hedged and unhedged internationally, and they were returning very different performances because of their exposure to the dollar. So it was an extremely difficult year depending on what side of that cable trade you were on. Finally, gold, such an incredible asset in 2019 and 2020. Really didn't show up in 2021. Predominantly that was because Bitcoin and cryptocurrencies decided to take gold's place as an inflation hedge. There was the perception as fixed income started to sell off that real yields were rising, wages were rising, the cost of everything was rising, and obviously if you have real yields rising and you have fixed income rising, that's a more attractive investment than buying gold, which yields you nothing. It is just a lump of metal. Whereas if you buy a bond, there is a coupon that you can be paid. So if that bond becomes more attractive and you get a coupon from it, i.e. you get a continual money stream, there is less of an impetus to buy gold, which does not do anything except sit in a bank. So that was a very difficult time. So 2022, looking ahead, the year of the value bull. I mean, I wrote this presentation before January, and what we've seen is a massive resurgence in value investing. We've seen a massive resurgence in value stocks over growth stocks. Why? Because the investors have decided that team transitory versus team permanent. They've decided that inflation is going to be more permanent this year and that central banks are really going to have to raise rates aggressively to get ahead of it. Now that means that the market started to price in 4 rate hikes for this year. Now in 2021, there was only 1 rate hike in 2022 priced in. Now there's 4. What's happened? Fixed income has come under extreme pressure as people reprice the perception that there's 4 hikes rather than 1. Growth investing has come under serious pressure as people start to worry that inflation is not going anywhere. Therefore, that future earnings profile of those growth stocks is not as good as it was in 2021. And also, growth investing has been phenomenal from 2008 to now. People have made hundreds and hundreds and hundreds of percentage point gains out of growth investing. So they're looking very attractive to take profits on and go looking for the next party in town, which are those low valued stocks, those low PE stocks. Importantly, those stocks that have earnings in today's market, your Unilevers, your Diageos, selling real products right now. So that's what we started to see, is an aggressive repricing. Some of the biggest and best growth funds in the world that, I read investment notes of people saying that these funds were not going anywhere. These funds were going to remain the best funds in the world for a very long time. They're down nearly 20% in 20 days. That's an extraordinary number for a growth fund to lose. And that's just outlines, this inflation narrative is forcing people's hands, is forcing the market lower. And if you're a value investor, it's forcing it higher. It's creating such a bifurcated market where if you're on one side of the fence, you're winning. And if you're on the other side of the fence, it's a very different story. And it's a very difficult market to navigate. But do I think that's going to continue? I do think inflation will remain more permanent this year. I think central banks are going to have to raise rates aggressively to get ahead of inflation. And most of the time, inflation only comes down when interest rates are so high that people start to take money out of the market. They don't go and buy that new TV. They don't go and buy that second car. They put it in the bank instead. And therefore, that car showroom, that TV showroom, that coffee shop, they start to see sales decreasing. And therefore, deflation starts to take in, prices start to come down. But that's quite a long way in the future. That doesn't happen overnight. And what we need to do is we also need to see these supply chain concerns from COVID coming off. This is going to take a while. It's not going to be an overnight flip. So you could start to see inflation staying a little bit more sticky than we'd anticipated in 2022. So I do believe that off the back of that, value investing will remain strong over this year, and it will be a good place to be positioned in 2022, but not without its risks. One, I must concede that there are a high amount of growth companies in the market that are getting sold off aggressively that are absolutely fantastic long-term investments. And what TAM's trying to do is we're trying to maintain those investments because they make sense longer term. We don't want to just start selling everything because it's negative, because it's down and we're fearful. We're trying to have a much more pragmatic approach. So very quickly, the known unknowns. Fed rate hikes, absolutely. Are we going to get 4? Are we going to get 5? Or are we going to get 3? We know that there are Fed rate hikes coming, but we do not know how many. The market's currently pricing 4. If it turns out that we're going to have 3, then growth stocks will rally, gold will rally, fixed income will rally. If it turns out we're going to get 5, you're going to get more of what happened in January. Again, that feeds into inflation and deflation. If you start to get more permanent inflation and inflation doesn't go anywhere, you will get more rate hikes to control it, which means that you will feed back into what assets start to outperform. China, we believe, is going to be an extremely good year. China, we believe, is already easing monetary policy and helping its economy grow. We believe that that's going to feed nicely into the stock market. And coronavirus, the known unknowns. We know that coronavirus still exists. The unknown is, are we going to get another variant? How are governments going to react? It looks to me like governments are going to start becoming more tolerant of COVID. We're going to move from a pandemic to an endemic. We want to live with the virus, not get rid of it. And I think that is hugely beneficial for risk assets. That's hugely beneficial for consumption. That's hugely beneficial for stock market valuations and company valuations. So I think that attitude towards COVID, which is shifting to the endemic phase, is going to be extremely good for sentiment. You're not going to get a COVID-induced sell-off or COVID-induced volatility like you used to. So yeah, there are some volatile known unknowns, but there are also some volatile dampening known unknowns like COVID. So it's going to be a year where things are changing in flux all the time. How can we invest into 2022? How can we beat inflation for clients? The reason why I've said it like that is because if inflation is running at 5% and you have asset values going up by 5%, it stands to reason that this portfolio, just to stand still, we need to be around the 5% range. Yes, absolutely. Active portfolio, active calls like China, very much. We want to be invested into that. Infrastructure on the right there is another great call, which is inflation protected. On the bottom left, you had the UK. The UK FTSE 100 was one of the laggards last year. It's been one of the laggards since 2008. It is incredibly attractively valued. And we believe that there is a catalyst in the works because of COVID and because of Brexit, where people could start to come back to the market. So that is a place we're very interested in. Again, on the right, gold is looking extremely attractive. China and India have been consuming gold faster than they ever have been, faster than they have been in the last 5 years. China's September consumption outstripped the entire 2021. There's a lot of demand in the market for gold. And if central banks decide to not raise rates as much as we are currently pricing in, fixed income will come back down. It will become less attractive, and therefore gold will become more attractive as a zero yielding asset. I hope that makes sense. But as always, if you want me to explain it to you personally, just give me a ring. Happy to do it. So how are we doing? TAM Premier. The performance has been strong and it's been gradual. It's been sequential all the way through, along with nice sequential volatility as well. Through 2021's volatility, we were able to manage our risk and we were able to manage that performance. We're extremely happy with it. And that goes back from 2015 to 2021. Again, TAM ESG looking even more sequential. That goes to 2016 to 2021. A nice rise in gradual volatility and performance, extremely good. However, ESG is coming under pressure at the moment. Again, TAM, Sharia, these are the mainstream flagship portfolios that we run. They all look the same in terms of sequential volatility and performance, which is the hallmark of a high quality DFM that can run model portfolios, which we believe TAM is. I'll stop there. I'll hand over for questions. Thank you very much for listening. You have a